Awesome. So this next stock, Netflix, is kind of one that I like to refer to as like my dirty little secret stock. And it's one that like everyone's talking about. It's like Netflix, Google, all these big boys all over the place. They're one of the bigger ones. But they've had like such huge growth compared to what otherwise has been happening in sort of the FANG stock, right? So you got like Facebook, Apple, Netflix, Google. You know, these guys are awesome. I love them. They're amazing. In the past couple of years, like Netflix has been the one that has the most growth potential. So you have to understand, if you're playing in like the tech, and I would just kind of put this in a bubble, and not like a bubble, although we might be nearing that, but like just this idea of like tech in general, because you know, we've got like tons of different market sectors, right? Like there's healthcare, there's industrial, there's energy, there's electric. Like for me, when you're making swing trades, like sectors don't really matter as much. You know, I'll trade an oil company just as quickly as I'll trade Netflix, as I'll trade a tech company. Like I couldn't care less. The only thing I care about at the core is like a pattern or technical analysis. And if there's a technical setup, then like I don't care what the company is. I will take it instantly off of the chart, right? But for longer term portfolios, it's kind of important that you don't have like everything in tech or everything in healthcare. Because like God forbid, like one of those do poorly, you can get screwed over pretty hardcore if everything you have is in the same sector. So it's usually not that big a deal. Most of the sectors in the long term, you know, you can look at all the different sectors, but in the long term, they might have short-term declines, but they usually kind of grow together based off of the overall market. But anyway, since we're looking at a lot of tech stocks, it's not gonna be worth kind of mentioning that. But these guys have been, oh my gosh, absolutely killer, really crushing it. Apple's been crushing it too. I own them. They should be in this portfolio. I definitely own them. But anyway, longer term stuff. So I got in here at 184, so I guess that was like probably right about here. Yeah, probably right about here. And ever since then, they've kind of just like exploded. And this kind of like brings into this idea, scalability. Like scalability is really huge. Scalability. There are a couple of mining companies I'm in that pay like ridiculous dividends. They're phenomenal. I love them. They're amazing. And they make a boatload of money. The thing with a mining company though is like there's only so many like mines on the planet. There's only so much coal on the planet. You know, there's only so much whatever. Like you can dig and dig all day, and there's probably like tons and tons of undug land. But like to make a mine, like you've got to establish a port, you've got to establish a train system for a larger mine. And it's just a lot of work, a lot of effort to like actually have a functional facility. And so like if you want to start up a new mine, it's hundreds of millions of dollars, sometimes dozens of millions of dollars for a bigger one. It's just a lot to start up with. And so because of that, with most companies, you have what's called linear growth, right? Sometimes it can be a little bit compounded, where they have, you know, they make one, they make another, they make another, they have another mine. Or they have one plant, they have another plant, they have another plant, they have another plant, they have another plant. And you kind of have like linear growth. Now look, linear growth, phenomenal. I love it, it's amazing, and it can be the backbone of your portfolio, it can be your entire portfolio, and it can absolutely crush it. For me, like, you know, you're looking for high growth investments. What I want is a company that can scale. And when I say scale, what I want is not like a straight line, but I want like a curve, right? And so when I think about that, when I think about investments, you think about stuff like Google that can literally scale exponentially. Think about stuff like Facebook that can literally scale exponentially. All these tech companies basically, maybe these guys have Apple just because it's hardware, but even then, like Netflix, like, well, what do you have to do to sign on a new user? Like, if you already have the infrastructure in place, if you've already installed all these like routers in the network, in the neighborhood, right? Like they've got routers in all the neighborhoods so that they can have faster delivery of content. Like if you already have all the infrastructure built up, from that point forward, all you have to do to get more clients is to sign up more clients, and you don't really have to do anything different. And it's very scalable, because to add somebody new to the network, to add some new Netflix user, all you do is generate a username and password and add them to the existing infrastructure, and you have marginal or incremental costs to do that. And when that starts happening, what's cool is you have like a really scalable company, a really phenomenal business that just kind of works. And so, as you're thinking about fundamentally, well, is this a good company to invest in or not? One of the big things you want to look at is this a scalable investment, yes or no? And if it is, great. If it's not, it still can be pretty freaking sweet, but you might not get the kinds of returns that you can see in bull markets where stocks literally triple in a couple of years, which is probably not like a a common thing, but like even if you look back at the past, right? We'll go over to the computer for this just to make it a little bit easier. But if we look at Netflix, right? Historically, like you can pull this chart. What's cool is a lot of people, they see all the growth, see all the gains that are happening right now, and they're like, oh my gosh, it could never happen again. Or they see kind of like the geometric curve that you'll see as you start to look at indices over time, right? And how they just keep going up and up and up and up. And like it's kind of daunting at first, but then what I realized is you can kind of go back in time. And like the further you go back, the more and more and more and more you see the exact same thing. Now obviously, these guys had a pretty huge crash a long time ago. They went from $40 to $10 in a very short period of time. I don't really know why. I was probably 10 years old when that happened. So like, I don't freaking know. Luckily though, I can look it up and I can ask other smart people who might know. And that's kind of a cool strategy. But dudes, you could buy puts on these and they would go up by like a factor of 30. I mean, it's crazy. The amount of potential you have in upswings and downswings. Because usually the downswings are actually faster than the upswings. And that's a really powerful concept that like can literally shift your entire portfolio. Once you realize you can make more money in a crash by buying puts or shorting than you could in like 5 years of an upswing. It just works, you know, and it's really cool. You can see historically they've like gone from like 50 cents to $1 to $4 to $40 in a very short period of time. And it's good to see something like a reverse split. You see here we have a 2-to-1 a forward split, sorry. 2-to-1 split. Also up here you can see we have a 7-to-1 split. These are really great things to see. When a company splits their stock, very fundamentally, very basic. You guys know it's like 2 shares turns into 1 share. 7 shares turns into 1 share. And so instead of it being a $700 stock, it's only a $100 stock. It's just 7 times more stock. Now what this is going to do from a liquidity standpoint, this is going to make it much more liquid and much less volatile, which isn't the best for like active trading, but for like swing trading over a couple of weeks, it doesn't matter at all. And what it does is it makes the stock more affordable for average investors who want to trade whole shares, and then they can buy it. You can buy it $100 or $80 or whatever, instead of $700, and so it opens up the doors for more people to get into the investment. And obviously it works out better because if you have more people buying the stock, more demand is going to lead to higher prices. So forward splits are absolutely phenomenal, and again, they're a problem that you only really get when you become a really valuable company. Obviously the opposite of that is reverse splits, and you'll see those with like really cheap sketchy stocks. You really don't want to mess with those too much, especially for longer term investments. You can definitely day trade them, they're phenomenal day trades, but if you see a company that has to go like a 10-to-1 reverse split where 1 share turns into 10 shares 100 times over the past 5 years, probably because they're trying to stay listed on exchanges at a certain price level they have to meet to stay through regulations, and people just keep selling them to lower and lower prices. And so they keep doing these reverse splits that totally eradicate liquidity and make the stock much more volatile because it has a much lower float, and it also makes it super like overinflated because the price gets pumped up even though there was an actual change in value. And even though it's the same market cap, a lot of people will see it as a more expensive price or a more expensive stock. Because of that, you see a lot of those start to sell off, even though it's literally the exact same thing, just with a different kind of branding, different kind of name tag on it. And so those are just kind of quick crash course. You guys should have learned about that in the Stock Market Series Exposed class, and if not, it's in 9 to noon, so I thought I would go over it real quick here, just because. So anyway, you look at Netflix, and you can see that like, over time, they have been growing like exponentially, like not just in the past couple of years, like over and over again. And this period right here looks super flat, but if you zoom in on that period, like it looks super big. And what I found looking at all the markets, like you can go to like any stock or any market, and I'll just do a quick example here on the S&P 500. What's interesting is, even though like in the short time frame that you're looking at, or in the current period that you're looking at, you know, you might see like this looks like a really big geometric exponential growth curve. What's interesting, and I guess this, let me actually get the actual index here, because this ETF doesn't go back all the way. But if you look at the actual index, not the ETF, at least not the popular ETF, like I think it's crazy that everyone bases their trades off of like one central ETF, because like that central ETF isn't actually controlled by like investors. It's mostly controlled by institutions that are trading huge blocks. And I'm not going to go too deep into this here just because it's kind of not related to this stock. Like there's like just this massive influx into passive index funds, ETFs right now, that is like so crazy high. And you've got a lot of people, like the guy who predicted the dot-com bubble and the guy who's in the book short, Michael Berber, he's saying that like, I mean, it is very simple. Like there is so much money in these passive investment vehicles that the moment people want to sell, you've got literally so much capital built up in this base that it's going to be a downpour in the whole market. And a lot of people, myself included, think that that's probably going to be one of the big factors behind scratches coming up. Probably a burst of that ETF bubble. Just because there were so many assets held in ETFs that aren't necessarily held in direct proportion in depository holdings, which again goes a little bit deeper than this course. It is in 9 to new, but you can learn about it there at a much deeper level, because once you understand it, all of a sudden it's way easier to profit off of it. But what's cool is if you look at like the history of something like the S&P, if you look at the history of any stock, right? This period right here looks super flat in retrospect. But if we zoom in on it a little bit, what's interesting is like this actually was a huge growth period. And like this is a lot of growth. And this is like tripling your money, quadrupling your money, sextupling your money. But it looks flat because of like the current standards. So even if like it looks like this is the only time period where there's been exponential or geometric growth, what's interesting is because like the magic of compounding, and over time, you start to realize that like the more you look back, the more it's literally the exact same story. It's just told out on a smaller relative scale historically because prices were lower historically. No, inflation was much different in the 1950s. Than it is right now. There were like 18% CDs, which is literally insane. I remember I was talking to one of my grandparents and I was like, hey, so, when CDs were 18% because of insane inflation, did you guys invest your life savings in CDs? And they're like, nah. And I'm like, dude, if you guys did, you would be like super rich. And they're like, yeah, nobody thought that inflation would ever go below 18%. And I'm like, oh my gosh. It's so crazy. You guys know CDs, like completely risk-free, interest-bearing accounts. You could literally get an 18% return on those at the time, and the stock market was going up like crazy. I think that was in like the 40s, the 50s, and you can see right here, I mean, thing freaking doubles in a couple of years. Anyway, I'm sure the stocks themselves were doing even crazier things, but I'm also sure it was a lot more difficult to invest just because of the way financial markets worked 100 years ago. You couldn't just like log onto your computer and then push a buy button. You'd like pick up the phone or like walk to the Wall Street. And anyway, the point is, even though it was much more difficult to physically invest, the market still explodes because financial markets are amazing and it's just long-term compounding. And so that's kind of one of the cool things. And here you kind of got like a W set up. I always kind of like looking at that as a W. But anyway, we'll go back over to our good friend Netflix and we'll kind of figure out what the big takeaways are from this stock right now. Because again, it comes back to this concept that even though the recent returns look huge, like historically, this stock has done really well over and over again. Obviously, they only IPO'd in like 2000, so they weren't through the dot-com bubble. But even, I mean, they've just done really well. They kind of weathered through 2008 really well, but they got hit by 2012, which was, I guess, kind of a bigger period for like when housing started crashing, when a lot of like individual homes started crashing, and a lot of business started crashing. My parents had closed the restaurant in 2012. Why? Well, it might have been 11. No, I think it's 12. Because you have a lot of contraction in consumer spending when the economy gets hurt. So you kind of see them getting hurt more so by that than anything else, just because Netflix, you kind of think about it logically, they're more of a consumer company, they're more of a client company, they are like a leisure company. You get Netflix to like watch TV and movies and stuff, and so if people can't afford to eat their meals, then they're probably not going to afford Netflix. And I'm sure there were also other things that were involved, like changing prices or whatever. But anyway, now we kind of get back to where we are right now, which is pretty freaking phenomenal. So we get in this investment, and it was a play based mostly on fundamentals. The PE, I mean, what's cool about Netflix is like they're a tech company, but like they make money. PE right now is about 90. They make a couple bucks a share, and they do pretty well with everything they've got. Like they have solid revenue, they have solid returns, and I guess they're kind of making more original content. I mean, just fundamentally, they're a pretty solid play. And you can kind of see, oh gosh, I've never seen this before. But again, just basic stuff here. Like they have solid volume, and more importantly, I think you kind of see right here, they have a solid estimate, like kind of matters. Really the big thing here is that they actually make money. So you see a lot of these streaming services, a lot of these online companies, they don't actually make any money. And this only comes when you actually make money, at least the majority of the time. You have to actually make money for that to happen. And so that's cool because that's exactly what they do. So I got in and then they went up a whole bunch. And like when you have a stock that goes from basically, we'll say 180 bucks, maybe 200 bucks to 400 bucks. Like when that happens in the span of a couple of months or maybe a year, like it's a very simple process. You sell the stock. I mean, it's like, what do you think, right? I don't sell everything, But I mean, at least for me, like I kind of knew that like there's no freaking way this thing's gonna keep going. So I think I sold like basically everything at 420 because I mean, like why would you not sell at 420? I mean, there was just a perfect combination of factors and numbers and stocks. So I sold full at 420 and booked a double profit on that, which is pretty nice. Like I can't say like I could perfectly predict this because a lot of like longer term investing or quote unquote investing in like bigger stocks or long term stocks comes down to you want to do two things, right? The first thing you want to do is you want to maximize your returns, and the second thing you want to do is you want to minimize the time that you're in a trade so you can roll over your cash into a new trade. And so for me, like Netflix might be $1,000 stock in like 10 years, and that's great. But if I can make like double my money in like half of a year or a year or something, or maybe it was 2 years, I don't know. I guess probably about a year, I don't know. Maybe 6 months. That could have been 6 months. Honestly, I don't have the numbers in front of me. But anyway, like if you can get out quick and you can make a bunch of money quick and then go and roll that over into a new investment, like that's probably a better strategy than just like holding through the downturn, losing almost all of the value that you gain, and then just praying that it keeps on going up. And so for me, like I saw this thing break, hit 420, and I just kind of like saw that. I was like, holy crap, this stock's not going to keep going up. And it's very, very difficult to predict exact tops, and it's similarly very, very difficult to predict exact bottoms. For me, I think I got a little bit fortunate on this one, which isn't something that happens often. I usually don't get too lucky. I just like to base things on numbers. But I think I sold pretty close to the top. I don't know exactly what the top was. I think I did a pretty solid job on that investment. It might not have been 420 exactly, it might have been like 14, but basically like it went up a bunch and then like you just sell. And that was kind of what happened with that investment. Now, looking at it now, like when I first got in, I didn't have anything to base off of. I didn't have any technicals. I was basing it pretty much exclusively off of fundamentals, just because like, it's Netflix and they make a bunch of money and it's Netflix. And it's not like that difficult of a decision to make. Looking at it now though, this looks pretty sweet. If I add Bollinger Bands, this will probably be a lot easier for you to see. Here we have Bollinger Bands, right? You can kind of see they've been bouncing off the top, bouncing down, bouncing into the top, bouncing down, and now they're bouncing back into the top. And that is a textbook interior Bollinger Band W setup. So you got the W right here. And what's cool about the W is it's inside of these Bollinger Bands, and it's pushing up against these Bollinger Bands. And I mean, this is literally like straight out of the book. I mean, this is gold right here. And so basically, I'm thinking like as soon as they hit about 400, I'll probably buy calls. Maybe hit, I think like they hit 400, I'll probably buy calls. Depends on the time frame. I want to see them hold 400 for about a week and a half, maybe 2 weeks. But if they hit that, then I'll probably snap up some calls here, stop loss kind of right about here. I would say probably stop loss at about 380, entry at 400. And basically what you're looking at here is you want to take this right here, which is about 260 conservatively, and you want to do about 260 to 380, which is about, $80 conservatively, looking at conservative numbers. And then you do 380 plus 80, gives you a conservative target of about, right here, just kind of do some finger math, and that should give you probably about 380 plus 80 is about 460, kind of conservatively. Might happen, might not happen, it all kind of depends on if they can break through and complete the setup. And if they do break through and complete the setup, then should be solid. And if they don't, no harm, no foul. So we'll kind of see how that one works out. But what's cool, and this is the big concept I want you to take away from this investment, just because this has been a really great investment for me. This was a bigger position too, just because, it's Netflix. You want to trade stocks that make you money. And you want to invest in stocks that make you money. And if you make a trade, and that trade makes you money, then you should trade that stock again, and again, and again, and again. Because if a setup works once, then it'll likely work again. And if a stock has great setups once, it'll likely have great setups again. And very, very basically, like, you want to do what works over and over and over and over again. Some stocks that don't really do well for you. Well, some stocks where you get in and you lose money and you're like, crap, I lost money. Don't trade those stocks unless you have like a godly technical setup. Like, you should probably just avoid stocks that you lose money, even if it's on accident. But if you make money on a stock, trade those stocks, because you want to trade the things that make you money. Because if it makes you money once, it's probably going to be easier to make you money again, because you've proven that this is a solid stock to trade, that it responds to technical setups. This one, the original trade I made on it was a fundamental play. So I've never really traded technical setups on on Netflix before. So this would be like my first time trading technical setups. But I have traded technical setups a bunch on AMD, and we'll get to AMD kind of soon. And so that's a stock that I've traded many times. Same thing with FLWS, 100 Flowers. I've traded technical setups on that stock many times, and over and over and over. I double, triple, quadruple my money on those positions. Like when you do that, you should do it again and again and again and again and again and again and again. And that's exactly what I've done. And so what's cool is, as a 90-day client, you have access to like a bunch of stocks and a bunch of portfolios. And a lot of those stocks are stocks that I've like made a ton of money trading. And a lot of them are like identified as like, these are portfolio stocks that like I've made a bunch of money trading. And these are really cool stocks. And others are like not really identified, but like they're kind of segmented out. They're kind of isolated from the rest of the investments. And with those stocks, what's cool is like you already kind of have a pre-selected list of everything you can use. So what you want to do is you want to go through those lists and find some stocks to trade. Don't base your information off of me, because I'm not you. Like make your own investments and then figure out which ones do well for you, like which setups validate themselves, which stocks do well, and then like keep trading the stocks that make you money and just kind of ignore the ones that don't make you money unless they have a really great setup. Like this will make it so much easier because now you're putting less attention and less focus on investments that fail, and you're putting more attention, more focus, more energy into investments that have proven themselves to be winners, and you can therefore turn into winners over and over and over and over again. And it doesn't matter if it goes up, it doesn't matter if it goes down, you can buy, you can short, it doesn't matter. I don't think Flowers in this position, in this portfolio, but I mean gosh, like so many great trades on that stock. Like it probably takes maybe 45 minutes to make a trade, it literally doubles. Because I know that it's a good stock, and I've invested the time early on and know that it's a good stock. So for these guys, like you can either learn two ways. You can learn the first way, which is just by investing in the stock, or you can learn the second way, which is by like reading an annual report, doing a bunch of research, or doing a bunch of fundamental analysis. You're looking at the past 20 years of price history, like we did on Texas Instruments, and saying, okay, I guess 90% of the time it's going to go up from August to January. You just want to like either do like fundamental research or just trade the stock. Trading the stock is easier, but it's also going to take longer, and it's going to actually require you to spend at least the amount that it costs to buy one share of a stock, or maybe $10 for fractional share or something like that. But either way it works, they're both phenomenal. And basically you just get experience with a company, and then you sit down and you say, okay, did I make money? Yes or no? If the answer is yes, you want to ask yourself, okay, did I like plan to make this money? Was this a technical move? Or was this just like a fundamental long-term move? Once you understand that, okay, so now that I know that this was a technical move, I should trade the stock more and more and more for technical setups. Now that I know this was a fundamental move, I should trade the stock more and more for fundamental setups. And if you invest in Amazon, it's like, I don't know, 2006, and then they go up by like 15 or 30%. You could be like, okay, cool, this was a good fundamental investment. I should stick with this for fundamentals. And then, obviously they have just exploded, right? And the big differentiator comes not from necessarily like being the smartest person on the block. Holy crap, these guys made a lot of money. But just realizing, okay, went up here, went up here, went up here. It's worked pretty well for me. This stock has made me money. If the stock makes you money, you should probably keep investing with it. And that's kind of one of the really big strategies that can yield a lot of returns, especially when you look at like longer term horizons and you actually think about like what something means, not now, but in the future. It's a huge strategy that I think do massive results. So with that said, it's also very scalable, which is the dream, and that's really what matters. And at the end of the day, is that you can do something not just with $100, but with $1,000, with $10,000, with $100,000, with $1 million, with $10 million, with $100 billion. People trade literally hundreds of millions of dollars in Netflix stock every single day. If I look at the volume on Amazon, there was about 5 million shares traded, I guess last Friday. That's 5 million shares times, give or take, a $2,000 stock. Right now, what, $1 billion, right? You have 5 million times 1,000, put 3 zeros on 5 million, you have 50 million, you have 500 million, for 2 zeros, 500 million times 2, instead of $1 billion. People are trading about $1 billion with this one stock in one day. Like, you can do that, right? Like, it doesn't matter how much money you make. Like, unless you have like more than $1 billion, it might take you 2 whole days to make your trades. And if you have more than $1 billion, you're not putting your whole entire portfolio into one stock. So like you should probably be good up to about like $100 billion from a diversification standpoint. So unless you're above $100 billion, like you pretty much have infinite scalability, because all you have to do to increase a trade is to just slap another zero at the end of it. Or maybe 2 zeros, or 3 zeros, or 4 zeros, or 5 zeros. and all of a sudden it's the same trade, it's the same setup, but you just make more money. And so that's kind of the game plan. That's the real goal here, is scalability, growth, and then when you really start to have your portfolio grow over time, and you're making bigger and bigger investments, what's cool is, you want to make sure that when you're investing, maybe 10 times what you start with, or maybe 50 times what you start with. Like, you want to make sure you're investing in good stocks that aren't going to lose all your money. And so what you do is you take all the stocks that you traded to make all of your money, and then you take this big list of stocks that made you a bunch of money and got you to where you are, and then you just, wait for it, because this is going to be super surprising, but it's also going to be really cool. You just trade the stocks that made you money over and over again to make more money. It's pretty basic. It's pretty simple. So that's kind of like the best screener you can have. We talk about screeners all the time. Screeners are amazing. Screeners literally are the place to start for almost every single new investor, and they are phenomenal. I use them all the time. They're amazing. But the best screener that you can ever have is a screener that you can't just get on Yahoo Finance. It's a screener that you can't just get online. And that screener is your winning position. And so it's really important that you have a list of the trades that you make, because some of the best trades you'll ever make are just trading the same stocks you've already traded. Again, it just works really well, because you know those companies, you know the feel of those companies, you know how it feels for that stock to move, you know sort of the general feel, price going up and down. You sort of understand how quickly a stock usually moves once you actually make an investment in it. Even if the investment's only like $8, even if the investment's only like $40, you're gonna learn so much more than you could ever learn just by looking at a chart. And so that's really the big takeaway here from Netflix, which is awesome, and hopefully will yield another good trade in the near future. So, with that said, thank you so much. Go out there, apply it, absolutely crush it. So we get a ton of value from this training, and I will see you in the next module. Thank you. Bye.